A Canadian pension fund has dumped an office building for $1, and essentially we are seeing cracks in the financial system that could create a financial crisis, especially when it comes to one bank in particular, which is Bank of Montreal, BMO. So anyway, let's get right into this, discuss what's going on here. So Fortune, guys, Canadian pension plan dumps stake in NYC commercial real estate. What is going on here? So let's talk about what is going on here. So basically, they've dumped an office building for $1. So essentially what's happening, Canadian pension funds have been among the world's most prolific buyers of real estate. I wonder why that is. It's because, you know, Canadians' view on real estate is that it's gold, because in Canada, we've been in this massive housing bubble for the past 20 years, and don't think that that doesn't affect people's views on real estate outside of Canada. I've seen the insanity of Canadians buying real estate in certain areas of Mexico. But anyway, let's continue here. So starting a revolution that inspired retirement plans around the world to emulate them. Now the largest of them is taking steps to limit its exposure to the most unloved property type, office buildings. Canada Pension Plan Investment Board has done 3 deals at discounted prices, selling its interest in a pair of Vancouver towers, a business park in Southern California, and a redevelopment project in Manhattan, with the New York stake offloaded for the eyebrow-raising price of $1. The worry is those deals may set an example for other major investors seeking a way out of the turmoil. And guys, it's not just what is going on when it comes to Canada Pension Plan. When you look at what is going on in the commercial real estate sector, from any angle, it just doesn't look good. So massive residential tower near Vancouver's downtown goes into receivership. So a major development project in Vancouver downtown peninsula has been put into receivership after BMO filed a petition saying it owed more than $95 million it loaned against the consortium that owns the property in August 2018. A BC Supreme Court order last week said the consortium owes $82.7 million plus $24,000 a day in interest rate charges from October 16th, 2023 onward. The consortium appears in court documents as 14 corporate entities under the umbrella name of Harlow Holdings, some of them numbered, and individuals. So again, you've just got to think, well, BMO is taking a pretty big loss there. They're taking a big loss on that loan because they're not going to be able to sell that office tower, are they, for the price that it was just a few short years ago and the price that they loaned against it, when you've got towers and redevelopment projects that are being sold for just $1 in New York City. So it's absolutely insane. And it gets more worrying when you dig into the details of what's going on with BMO. So this was put out on Twitter by Wower, and it's basically BMO's net write-off of loans. And you can see that the trend here is not looking good at all. So it's around $600 million, which in comparison to their entire portfolio is still low, but it is the trend and the increase that we're seeing here, just like when it comes to the delinquency rates that we went over the other day. So basically, BMO net write-off, you can see here, it's up above 600 million, and it's up over 200% year over year. What does net write-offs even mean? It essentially means loans that are impaired, people that can't pay the loan, and then the bank has to write that off, and it's basically called a write-off. So essentially what's happening is you're seeing more and more borrowers that cannot pay back their loans, whether it's commercial real estate, residential real estate, or whether it's anything. When it's just money lent out, it's just not getting back, and more people are defaulting. And right now, guys, I don't see that trend letting up anytime soon. Do you? I mean, look at this chart again, guys, and you can tell me, do you think this trend is suddenly going to start reversing and coming down, and we're going to have this soft landing that everybody thinks is possible? I really doubt it and don't think so. And then another thing, RBC announced on their earnings call addressing what we were going through the other week, literally, when it comes to the mortgage fraud at RBC. The question arose on today's first quarter earnings call at RBC in the wake of the whistleblower allegations of the mortgage fraud scheme at HSBC Canada's Greater Toronto operations prior to RBC's acquisition of HSBC. They basically addressed it by saying they are very, very comfortable with the due diligence that they did. And we know these banks are just so great at that. So it's going to be no problem at all. And then you've also got National Bank, which sees delinquencies for its variable rate mortgages rise to pre-pandemic levels. So if you get into the data here, National Bank of Canada, the country's 6th largest bank, saw a rise in mortgage delinquencies during the first quarter, with the largest increases contained to its insured variable rate mortgage portfolio. Why would that be? I've said it many times. Basically, if you're putting less than 20% down, you're on an insured mortgage. That is a subprime mortgage subsidized by Canadian taxpayers. Nobody seems to understand how that influences real estate prices as a whole when you've got more and more subprime borrowers that are coming into the picture. Just complete insanity, in my opinion. So they would be the first to crack when it comes to it. And they are insured by your taxpayer dollars, believe it or not. So the delinquency rate for National Bank's variable rate client jumped to 0.21% of its portfolio from 0.14% in Q4 and 0.07% in Q3. That's now on par with its pre-pandemic rate of 0.21% reported in Q1 2020. Guys, think about what they've said there. Look at the jumps. Just look at the jumps in default rates that we are seeing right now. I know I seem like I'm crazy, but I'm trying to drill this through on these videos, and I hope it's coming across, because this is getting serious now. The defaults, they are coming, and they're coming in quickly. And that is always the case when credit bubbles implode. The default rates just don't steadily go up. They happen quickly. And if you haven't seen the video, which I did the other day, which was showing how much mortgage delinquencies have surged, then watch that. I'll link it in the pinned comment and at the end of this video. But anyway, let's continue on here. So variable rate mortgage delinquencies have continued to normalize as borrowers have absorbed a significant increase in interest rates, Chief Risk Officer Bill Bonnell said on the bank's earnings call. So again, they're trying to keep it warm and fuzzy there, as you would think. But you know, when you're looking at the household debt picture, it does not look good. When you have this peak happen, it generally means the bubble is imploding, the debt bubble, the credit bubble, because that's what it really is. And you know, guys, it is getting serious. Delinquency rates are really starting to rise. These banks are going to be under more and more pressure. I think by the summertime, you're really going to see credit tighten up, which is going to impair the housing market even more, because then people won't be able to get the loans as freely. And that is really what sets fear into the housing markets, because you will see transactions really start to slow and stall. And then basically it can go into free fall very quickly, because I already believe there is a lot of fear baked into the market, because there are so many people that are saying they're going to offload their property this year. Well, good luck with that, because everybody is saying the exact same thing. So we'll see how this plays out as it continues through the year, but the trend does not look good. And also, guys, I want to touch on this because this just made me laugh. Toronto home prices inch up as buyers adapt to mortgage rate landscape. This seems so warm and fuzzy, doesn't it? But I wanted to show you this, just how the real estate boards influence the mainstream media and how this all comes about, this FOMO that's created, the fear of missing out that I've talked about so many times on this channel. Basically, they said Toronto area home sales jumped by 17.9% year over year February, while the benchmark home prices inched up slightly. They didn't tell you how much listings went up straight off the bat. They didn't tell you how much the actual price increase was either. That's the misleading thing. And most people, guys, they won't even read past this headline. In fact, surveys have been done in the United States that show only 40% of people read past the headline on a news story. So they'll see that come up in their news feed and they'll think, oh, prices are on the rise again. Time to get back into the market if they're looking to buy. But anyway, just insane. So a total of 5,607 properties changed hands during the month, while new listings surged by 33.5%. So sales were up 17.9%, new listings up 33.5%. I don't know, but that doesn't sound like a seller's market, and that doesn't sound like it deserves the title and the headline that they've given it there. But anyway, it's the real estate board. So data from the real estate board showed the benchmark home price increased by just 0.44%. They literally said by just 0.44%. 1%. But they're saying on the title, they're inching up. Sounds like they're going up by a millimeter, not an inch. It's just crazy. The spin that the real estate industry continues to try and put on stuff. It's unbelievable. So TREB president Jennifer Pierce said a resurgence in sales activity came as buyers have adapted to the mortgage rate landscape. Oh God, this is just insane. And here's the chart of residential prices in Toronto. I don't know. You tell me. Does that look like a really strong chart to you guys? I don't know, but it doesn't look like it in my opinion. And you know what, guys, with everything that's going on right now with the banking system, with everything that we're seeing happening with delinquencies rising, does it really seem like a logical time to jump into a housing market like Toronto, which is at these insane heights right now? And as I discussed, you know, other markets are insanely risky too, like Calgary. Because the fact is, if somebody buys a house in Calgary and then they fall on hard times, lose their job or lose some employment, they're not going to be able to move and rent that out. Or if they have to move back to Ontario because of job loss or anything like that, they're not going to be able to rent that out and make the money back. There would be negative cash flow and they themselves would be in distress and going into foreclosure. So you can see the cracks, guys. You can see the cracks. They are clear as day coming out right now. And it is only people, sheep with their heads in the sand, who cannot see what is going on. The financial system, the banking system is beginning to implode on itself. Here is that video that I was talking about earlier in this video. I'd highly recommend that you check that out. If you're looking for a VPN to get around the censorship laws in Canada, I would highly recommend you use the VPN that I use, which is ExpressVPN. Go to expressvpn.com/marketmania. Thank you so much for watching this video, and I will see you in the next one.